DuPont identity from the financial statement analysis. And we're going to start from the concept of ROE here. So, what's the problem with using ROE as a measure for managerial performance? Well, it turns out that ROE is just ROA times the equity multiplier. And if you remember correctly, that thing is just total assets over total equity, or 1 plus total debt over total equity. So if I'm a manager and you tell me I'm going to get rewarded based on ROE, here's what I'm going to do. I'm going to go out and I'm going to borrow a bunch of money and I'm going to buy back a bunch of stock, and voila, I will increase ROE. Now, have I brought additional value to the shareholders? Absolutely not. And here's why. As we increase the debt at the firm, it increased the risk. And of course, the return on that equity is going to need to go up. And so we've got to be careful rewarding managers based on ROE. So the question is, how can we keep crafty managers honest? We're going to talk about something called the DuPont identity. It was developed by a company called, you guessed it, DuPont. Has anyone heard of DuPont before? Big American, well, not American, maybe French, chemical company. And they're really good at what they do. I was actually in a DuPont plant, say 2001 or 2002, and man, they have got their stuff together. In fact, let me tell you a quick story about DuPont. They used to make dynamite. By the way, my dad spent 40 years in a dynamite plant, so I have some inside information about how this process works. If you had to assume what a dynamite factory looked like, would you think it was one big building, or would you think it was many buildings? Yeah, many. Why?
Because if it's all in one building, then it'll blow the whole inventory.
Oh, yeah. So if everything is in one building and you get a fire somewhere, the whole thing is going to go up. Now, where my dad worked, all these buildings were in a line, and so they called it the powder line. But at DuPont, they had the building set up like this. Now, of course, I'm not going to draw all the buildings, but this is generally the idea. And the problem was at DuPont that they had a lot of accidents on particularly the night shift, but overall, huge amounts of accidents, huge amounts of fatalities. Are those good things? No. And keep in mind, this is in the age before the Occupational Safety and Health Administration. And so there's maybe not government pressure on them so much, but there is the pressure of the families, there's the pressure of the shareholders and things like that to try to keep them in line. So they had all these problems, and primarily the problems occur on the night shift. Does anyone know why the problems primarily occur on the night shift? Anybody here ever work a night shift job? Oh man. So let me tell you how this works, since you guys have been sheltered to date. When you're the new person, do you think you get one of those sweet day shift jobs? No, man. You're put on what they call the graveyard shift. Starts at like 11 o'clock at night, goes to 7 o'clock in the morning or thereabouts. Now, you got all these new people. They are basically up all night when humans are supposed to be sleeping. I know you guys don't recognize that, but they should be, right? And so, as a result, they end up making a lot of mistakes. Now, let's ask ourselves how people get to the day shift. You have to survive long enough on the night shift to make it to day shift. So what does that mean? It means if you're really not that great or skilled, you'll probably get killed on the night shift before you ever make it to day shift. I could take you to a cemetery in my hometown where there's a whole row of people with this date in 1954. They all got killed on that same day. And it was a night shift, I believe. Okay, now back to the story. Here's the solution DuPont came up with for this problem. They built a lovely home right here in the middle of the compound. And they told the manager he had to live there. And back then it was all men, right? So told the manager he had to live there and that he had to have his family there. How does that change the equation for the manager?
Gives the person to see it.
Yeah, oh my goodness. So first of all, he's there all the time, right? If he catches a whiff of smoke, do you think he's going to do something about it? Oh yeah, he'll run across the compound in his pajamas to make sure that things are cool. Literally cool. Then he's there. He's got a vested interest now, because if this place blows up, it could kill him. But worse than that, it could kill his kids, right? And so it really put the emphasis, it aligned the interests of the shareholders, the employees, and the manager all at the same time. Now, could you get by with doing that today? Absolutely not. But I wanted to show you how creative DuPont can be when they're coming up with ways to incentivize their managers. And that's where we come to the DuPont identity. The DuPont identity is just another way, a lot of students think, of calculating ROE. Well, ROE is easy enough. It's just net income over total equity. But the DuPont identity breaks this down into three components. Profit margin times total asset turnover times the equity multiplier. Now, if we do the math, or actually it's algebra, if we do the algebra here, we can see that, of course, profit margin is net income over sales, and total asset turnover is sales over total assets. The sales, what happens to the sales? Oh, so someone here must have passed algebra.
Cancel out.
Yeah, they cancel out. And then when we multiply the equity multiplier times that, what happens to the total assets?
Cancel out.
Yeah, they cancel out too. And so what it really leaves us is net income over total equity. So the purpose of this slide was just to prove to you that we're really talking about the same thing. Now, why in the world are we interested in breaking these things down like this? And the answer is what these three things represent. So profit margin represents operating efficiency. Remember, we said in a market with basically a commodity idea, which a lot of DuPont stuff goes into the commodity market, plastics and explosives, you can buy those other places. The only way you're going to increase your profit margin, you can't increase your price. What do you have to do? Oh, for shame, she's late. What are you going to do? How can you increase your profit margin without increasing your price? Oh, come on.
Increase costs.
Increase what?
Or I said decrease costs.
Decrease costs. Very good. That's what we're going to do. And so that's why we call it operating efficiency. Now, of course, we talked about the kind of costs you want to get rid of and the non-value added costs. But you're going to work at this, and it's called operating efficiency. And then the next one is total asset turnover. It's a measure of asset use efficiency. So basically, it's how much in sales can we produce for every dollar of assets? And the higher that thing is, the better. And so we would like to have a higher total asset turnover. We'd like to have a higher profit margin. And we're going to tell them that they can only do this, and they are not allowed to touch financial leverage, because otherwise they'll just play this game we talked about earlier. And so what does this force people to do? Well, they could focus on profit margin alone, and they could do something silly like raising their prices. What would that do to sales? Yeah, sales would go down. What would that do to total asset turnover? Yeah, it's going to go down. So basically, you're helping yourself in one area but hurting yourself in another. Or I could say, wow, I'm going to focus on making my sales as big as possible. I'm going to cut my prices. What would that do to profit margin? It's going to cause it to go down. And so you really can't maximize one of these you can't cheat this system. Because if you cheat it by just artificially lowering or raising prices, you're going to hurt yourself in the other area that you're being judged on. Does that make sense? Okay. And so what are managers going to do? They're going to, as we discussed, cut non-value added costs, and they're also going to try to get rid of unnecessary assets. And so if we have, if our plants are at low utilization, maybe we consolidate. When I was with Halliburton back in 1994, we had a factory at Davis, Oklahoma, that we had built when times were really good. Well, then when the market came back to regular times, we didn't need that factory anymore. It made all the sense in the world to sell that factory. That would reduce the total assets and it would help our total asset turnover. Does that make sense? Okay. Now we're changing gears here and we want to talk about problems with financial statement analysis. The first one that we have to be careful of are conglomerates. Remember, we've said that these ratios tend to go with industries. The definition of a conglomerate is a company that works in many different industries. And so you can't just take these numbers for one conglomerate and compare them to another. You say, wait a minute, what if they are in the same industries? Great. Well, are they exactly the same weights in those different industries? Do you know what I mean by weights? So let's talk about Eaton and General Electric. Eaton and General Electric both make motors, but General Electric makes a lot more than Eaton. Eaton makes airplane parts, so does GE, but Eaton may make more than General Electric. And so the proportions are different, even if the industries are exactly the same. We had, when I was at Halliburton, it was actually a conglomerate. There was energy services, but there were different types of energy services we were providing, so they were kind of sub-industries. But we also had an insurance company. Our biggest competitor was a company called Schlumberger. It looks like Schlumberger if you read it, but Schlumberger. If you look at them, they were in the same energy services industries that we were, but they didn't have insurance. And additionally, if you put gas in your car, you may notice that the pump is made by Schlumberger. If you look at the water meter at your house, you may notice it's made by Schlumberger. And so even though we were both conglomerates in the energy services sector, you still can compare those two companies based on their ratios. Does that make sense? Okay. Now, then there's seasonality. So, for instance, let's take the market for Christmas ornaments. When do people typically buy Christmas ornaments? Is it June? No. Typically, I get to thinking of that at Thanksgiving dinner, like, oh crap, I gotta put up the tree, right? That sort of thing. People start doing it in October now, it's kind of freaking me out. Back to this, let's assume October, you're gonna buy these things. When does that mean they need to arrive at the store? Before then, right? By the way, where are these things made? China. In fact, there is an entire section of a city in China that's purely decorated or dedicated to Christmas decorations. And it's just amazing to go walk through and see all the crazy stuff. And Mr. Wong could tell us, Mr. Wong, Santa Claus and the saxophone, why are they related in Chinese culture? Do you know? The saxophone. It's so weird when I see Santa Claus playing the saxophone. Do you not see this in China? Maybe we go to a different part of China. Okay, back to the story. The point is, this stuff's made in China. Do you think they fly it over air cargo? No, that's expensive, right? And this stuff's low margin. So what do? They're going to put it in a shipping container. And so that shipping container takes at least 6 weeks to cross the Pacific. More now than it used to. And so what are we saying? We're saying that in order to have those orders ready, these people over in China have to be doing their work much sooner. But they have to be building up that inventory, and their inventory is going to peak probably, let's say, July. And if you compared their July inventory turns with their August inventory turns, you might come up with some very different kinds of numbers. because of the way the seasonality works. Their inventory has to build up, and then basically it's all gone. And then it has to build up, and then it basically has to go away. Their sales all basically happen at once. And so you can't look at those companies based on the same benchmark for each quarter, because they're not the same. So how would I look at that company? I would say the fourth quarter for this year and compare it to the fourth quarter for last year. Does that make sense? And that's how I can get away from the seasonality problem. Then we have different methods of accounting between countries. We have GAAP. What does GAAP stand for? Anybody know? Generally? Speak a little louder, please. Oh, very good. Generally accepted accounting principles. That's what we use in the United States. IFRS, which is the International Financial Reporting System, is used pretty much everywhere else except for China and a couple of other places. And so a lot of times, if you're trying to compare your company versus one that is based out of another, like a European country, you would be out of luck. So let's give you an example. I'll go back to Halliburton and Schlumberger. Halliburton is based out of the United States. They are subject to GAAP reporting requirements. Schlumberger is based out of the Dutch Antilles. You guys even know what that is? There's some like islands. I assume the weather's nice there. The Dutch Antilles. Not only is the weather nice though, the corporate tax rate is 7%. So that's why Schlumberger is based out of there. But because they're under this European Union kind of umbrella, all their accounting is done in IFRS. And so this is another reason that we just couldn't compare Halliburton and Schlumberger, because they are on fundamentally different accounting systems. So let's give some examples on differences between those two. The big one that I can think of right off the bat is the way that they account for research and development. In the United States, research and development costs have to be expensed at the minute that you incur them. And so if you hire a bunch of scientists to work on the next iPhone and you pay them $1 million, you gotta expense that right now. And so it comes off of it eats into your net income. And the same is true in IFRS, except to the point that you reach technical viability. What do you think technical viability means?
So is that like when they're creating something, it becomes like an asset, it's like no longer a project?
Yeah, and that's what they're saying here. But technical viability means that I try the thing out and it actually works. Does that make sense? Now, as a former mechanical engineer, I can tell you that I've had many minutes where I thought, hey, technical viability, and then the damn thing blows up, right? So to me, it's kind of a fuzzy line. Where is technical viability? Or feasibility. Then what they do, they declare it. At that point, any money they put into it is considered investing into an asset. And so these European firms will have greater assets and higher net income, because after all, they're not having to expense that R&D as they go. Does that make sense? And so there are lots of weird little things like that you can't compare GAAP versus IFRS. And then there are different currencies between countries. And so I could look at my net income of 1 million and Mr. Wong's net income of 7 million and say, wow, mine must be really bad. But the trick is, his is in RMB, renminbi, which is the currency of China. That's about a 7-to-1 exchange ratio. And so our companies could be identical. His numbers just look great because of where he's at. Now that's a very simplistic look at currency. What about companies that do business in different places? So what if you've got a company in the United States that is bringing in money from abroad? So they could be performing exactly the same as a company that's in Europe. What if the dollar starts to weaken? Those euros that they're receiving are worth more dollars, and it looks like they're doing better. In the meantime, their German counterpart who is selling in the United States, when they repatriate that money back, it buys fewer euros, and so they look like they're performing worse. And so this is another reason that we can't just do these straight up comparisons. And then finally, we have different methods of accounting for inventory, LIFO versus FIFO. Can anyone tell me what LIFO and FIFO mean?
Last in, first out.
Very good. LIFO is last in, first out, and FIFO is first in, first out. And what this means is when I sell an item off the shelf under LIFO, I use the cost of the last one that I bought to put on the shelf as the cost of the item that I've sold. Now, I don't necessarily have to go and find the last one that I put on the shelf. I just have to say that's what I paid for it. Now, FIFO, on the other hand, is first in, first out. The cost of the oldest one would be what I would record as the cost for meeting that sale. Now, in non-inflationary times, it doesn't matter one bit. And it's so interesting because over the course of my time as a professor, here's about 15, 16 years now, I've never had anyone really interested in this topic before because they all assume that inflation is really tiny. Is inflation really tiny anymore? No. If you guys haven't noticed, the price of everything is going up. That's inflation. Okay, so what does that mean? It means that the last one you put on the shelf will undoubtedly have a higher price on it than the first one you did. So what impact is that going to have? Well, the firm with LIFO is going to have a higher cost of goods sold. And so therefore, they are going to have a lower net income. And you say, why in the world would anyone do that? They're not trying to get the lower net income. They're trying to get the lower pre-tax income because what does that do? What does lowering your pre-tax income do? Yeah, it lowers your taxes, right? It lowers your taxes. And so that's why they're interested in doing that. Now, strangely though, it has another effect. It makes your inventory look artificially small because the things that are left on the shelf are valued at lower numbers. And so a company with LIFO accounting may look like they've got a lower profit margin, but on the other hand, they might have, they would look better on their inventory versus someone that did FIFO. They're operating exactly the same. The only difference is the amount of taxes that they pay. When I first went to work for Halliburton, they're going to make a lot of appearances today, by the way. When I first went to work for them, they were doing FIFO. And we brought in a bunch of guys from GE, and they're like, are you guys nuts? You got to do LIFO. And as soon as we did LIFO, it was interesting what happened to our taxes. Of course, they came down. And so that's cash flows. Taxes are a real cash flow, right? Yeah. And so that's something we do need to worry about. Okay. Any questions about these problems? I want to touch on something that we mentioned last time where we said you can't always go with bigger is better on these financial ratios. And I wanted to give you an example that I ran into yesterday on inventory turns. Remember we said that it's cost of goods sold divided by inventory. So if you can drive down your inventory, it's higher. But if you drive down your inventory far enough, you start to have what we call stockouts. Stockouts are where you don't make a sale. Now, Walmart is my favorite example of stockouts. When I go to Walmart and they don't have what I want on the shelf, so I got my shopping list, and this is all pre-pandemic, of course. I've got my shopping list, and I go in there, and they don't have item number 1, they don't have item number 2, and they don't have item number 3. What am I likely to do? You guys just keep going down the list? Yeah, leave. And you know what? I leave the shopping cart in the aisle, and that's going to cost them another 12 cents of labor to take that back up front, right? Now, does Walmart know that they've actually lost a sale that day in that case? No, they have no idea, but it's still a real cost. We call that a stockout cost. Now, move forward to yesterday. I ordered 3 bottles of this saline nasal spray, because you're not dry in the winter, right? When you guys get old, you'll know about these things. Okay, 3 bottles, and they're 3 ounces each. And they were selling for $3.63 a piece, I think. And they didn't have those, so instead they did the substitution thing. By the way, I'm picking this up at the curb. They did the substitution thing. You guys know how this works at Walmart? Okay. So the substitution is they have these 1.5 ounce bottles that they were selling for $1.99. And they gave me 6 of those instead. $1.99 times 2 is $3.98 versus the $3.63 or whatever they were going to charge me for the one. And so they're losing money on that, but at least finally they have an understanding that they are actually incurring a stockout cost, which is something they never had before. So be careful about driving your inventory too low, because you start to miss sales, and sometimes you won't even know that you've done it.